Hi, this is Randy Finney with Right Side of the Chart, and today is Thursday, August 17th, 2017. I wanted to do an update on the semiconductors today, and earlier I received a question in the trading room, which really segues nicely into the whole outlook for the semis. Let me share that question with you here. Let's see. This was from earlier today. I had a member here in the trading room in response to a post that I made, and let me back up for a second. I made an update in the trading room earlier today about the semiconductors, basically stating there's three main semiconductor ETFs that I follow, each tracking just a different basket or a different index of semiconductor stocks. Um, but as the trend has been so resilient in the semis, it's best, in my opinion, to wait for some really, compelling evidence that they've broken down. So I'm watching SMH, SOXX, and XSD. Those are all three different semiconductor ETFs. So I mentioned earlier in the trading room that the SMH and SOXX were both testing their primary uptrend lines off the 2016 lows. I'll get to those charts in just a sec, and that XSD had already broken down recently, back tested over the last couple of days, and as of today was rejected very impulsively off that back test, meaning off that trend line from below. So I made that update, and a member within the trading room had asked my opinion, my thoughts on a trade that he or she took. Should I close? Basically said they took a semiconductor, and I'll show you the chart on that one in a second. It was Brooks Automation. And should they close the position earlier than planned? I think this is a great question, and it doesn't only apply to semiconductors, just trading in general. And I'm just sharing my thoughts here on this. I just make clear that I can't give anybody specific investment advice or tell you what to sell, what to buy, when to buy it. You have to make those decisions. I can, and I'm glad to share my thoughts. In other words, if hypothetically, if I were in the same trade, what would I do? Doesn't mean that's a blanket answer that everyone should follow, but it might give some insight. So number one is let's take a look at that position, and more importantly, look at the semiconductor sector, because this question was put to me based on my analysis that the semis are they're certainly in a very precarious situation. But I want to reiterate that we have some evidence here of a breakdown, but not enough. Since the trend has been so resilient, it's been tough. We tried some shorts early in the year on the semiconductor sectors. I think maybe one or two individual trades panned out to their earlier price targets, but as a whole, we were stopped out on the ETF and some of those individual semis. So it's been a tough trade. And as such, I've been watching it closely, and we'll go over those levels, same levels I've been watching now for a while. And then that also plays into how this particular trade might play out, and then more importantly, to get to that question, how it affects, should somebody modify their trading plan. And I'll just talk on that real quick. There's two schools of thought. Before I get into those schools of thought on the trading plans, everybody should have a trading plan, and a trading plan is simply, what do you plan to buy, why do you plan to buy it, where do you plan to buy it, and what, certain price trigger, breakout of a pattern or above a certain level. How much do you plan to buy? You need to know ahead of time, not after the fact. What percent of your portfolio do you want to commit to that particular position? Where do you plan to take profits? And if the trade works out against you, where do you plan to stop out? So those are the core, basic elements of a trading plan. And everybody is different. Personally, I like to use a risk to reward ratio of at least 3 to 1 or better. And what that means is for every dollar of risk that I'm willing to take on my stop, I'm shooting for a profit target at least three times that, or in other words, $3 a profit for every dollar or unit of loss on the downside. Now, with a 3 to 1 RR, you don't have to be right all the time. In fact, if you look at it this way, if you take a trade, and we'll just talk in units here, let's say it's a dollar. Let's say I'm trading something that's $50 a share, and I'm taking a 3 to 1 RR for a dollar loss or $3 a profit. So I can lose on the first trade, I lose a dollar, take another trade, fail again there, that's $2, and then be successful on the third trade for a $3 profit. Therefore, out of three trades, I was wrong 2/3 or 66% of the time, but right on that third time, and I'm still profitable because I've made $3 after losing $2, so I'm still ahead by a dollar. And that's the one of the key components of trading. If you're shooting for a dollar profit, but you're willing to take a dollar loss on every trade, can you be successful in the long run? Sure. If your success ratio is well above 50%, that's the key. If you're only 50-50 at best and you're spinning your wheels, you're breaking even at best, and you're giving up commissions to your broker. Um, so those are considerations that I make. Now, back to the this particular trade here. Okay, here's a link of the chart that member had shared with me for Brooks Automation. And it looks like a solid, solid trading plan. There was a reason for taking the trade, as stated here. Bought after symmetrical triangle breakout, so there's your entry. You had a reasoning for buying the stock, and a stop you can see is set here at 23.66, and a first target at 28.78. I don't know if there's any additional targets overhead, but either way, just eyeballing the chart, not doing the math, that looks to be close to 3-to-1 RR. 1 unit of downside, and this looks to be at least 3 times that to the upside. So at least by my criteria, this looks like a solid trade. Now, the two schools of thought on on a trading plan, at least the way I look at it, some traders I know are very rigid. They have a trading plan, they set their stops, they set their profit targets, and one or the other is going to get hit. And come hell or high water, that's it. There's no deviating from that plan. There's no second guessing it. Takes the emotion out of trading. And I can tell you this right now, one of the best tools that I think is out there in trading is the OCO orders that brokers offer. They're also known as OCA. OCO means one cancels another. OCA means one cancels another. Same exact thing. What it is, you enter a trade and immediately you turn around, you place an OCO order with your stop below and your profit target ahead, and the system will then automatically, you set those as good to cancel so they stay open, not just for the day, but going forward. And then you don't have to be in front of the computer. And even if you are, you let it ride. It takes the emotion out of trading. As long as the trade, the reasoning behind the trade was solid, you let it run, and you're either going to be stopped out or you're going to hit your profit target. That's it. It's that simple. So it takes away a lot of that second guesswork every time the position goes against you. Or has a big update. I take profits, and why have them? You're booking profits too early. That tends to be a problem with a lot of traders. Even if you're disciplined with your stops, if you're not, again, letting your profits run at least up to your targets, then you're getting closer to that 1-to-1 RR that I talked about, or anything less than a 3-to-1 RR. So that for on face value, this looks like a solid plan. Personally, just to critique it a little bit, I like to see at least 3 reactions on a trend line to help validate it. See, we had a one over here, first reaction right here, second reaction right here, and there wasn't really a reaction there because we went up right on through there. So a reaction would have been a pullback from that level and then maybe a breakout. That would have helped, at least in my opinion, validate that trend line. Likewise, we have only 2 reactions down here below. So that's just a little sidebar. Everybody's different. That's, in my opinion, that I would have questioned this triangle somewhat. Now let's get back to the point. Do you modify the plan? Personally, I do. I like to stick with the trading plan unless the charts have really convinced me otherwise, that whatever reasoning that I entered a trade, something has changed in the outlook for that stock or ETF or sector, whatever it is I'm trading, and then I'll be a flexible and modify my trading plan. Now that can come in many forms. That may mean at this point, let's just use this as an example because we're here. It may mean that I just close a trade out. I see no reason being long anymore, whether I'm at a small profit or a small loss. It may entail raising my stops, tightening the stops at that point, saying, well, the reasoning for taking the trade I don't believe exists anymore. I'm going to bring my stops up to not far below where we closed today. That's another idea. So again, I see nothing wrong because, as I often say, the charts are dynamic, meaning they're constantly changing. Therefore, my analysis is how little things, yes, they change, charts change day to day gradually. It's the big changes, such as, for example, now let's get back to the semiconductors. Um, Here's SOXX. Now, I had this trend line in recent videos. I had it up here catching that most recent low right there. I've lowered this now. We punched down below there the other day and popped right back above it. Now, so you can see here I had a reaction there, and I actually undercut that candle a little bit. So what I'm going to do is again give the benefit of the doubt because the trend in the semis is unarguably bullish. And until we have some pretty compelling evidence, and that evidence may come soon because we're on this trend line, um, but until then, give it the benefit of the doubt. You don't want to try to convince yourself as hard as possible to take a trade. When I look at a trade, I like to study the charts and try to find a reason why I shouldn't take that trade. I think that's a better way to approach it. So what I'll do is I'll move this trend line down. And it's nice because it's still now it captures perfectly the bottom of that candle. That candle almost gets that one, almost a third reaction there. And then we have this reaction the other day. Now, from my experience, trend lines are visited. A lot of if you're looking at the semis, a glass half full, you want to buy pullbacks to support. And a trend line, there's no better support than a multi-year trend line, and you have horizontal support right below there. Um, so you could have bought the other day, game to bounce. Now, typically in a very healthy uptrend, when you come back into back test an uptrend line after you've been above it for a while, usually you're off to the races. So what happens? We had a bounce, typical reaction, but it was very muted, very weak, lackluster bounce, and we're already back down. One big red candle today has brought us back down to there. So that is a little heads up, if you will, for the semis. Again, we need to see more evidence, and we can actually draw a little triangle right now at this point. So this thing's going to break one way or the other. You have support not far below, um, and it does kind of, again, it segues into that whole answering the question on the other trade. If the semis break down, and they are certainly in a very precarious position. In fact, I've made the case in recent videos, this was likely a top. This was a extremely powerful bearish engulfing candlestick. It engulfed weeks of previous trades, all the previous candles, and we're still yet to even, we came up about halfway, a little more than halfway above that candle, but we have yet to take that out. And that is a potential topping candlestick there. So keep that in mind. And now if we break down below this trend line, we have support not too far below. So there's another ETF dancing right on a key support level. And then we have XSD, which is a Spiders S&P semiconductor ETF. One, two reactions there. I also modified this trend line. I had mentioned in the trading room the other day because this is how I had it drawn before. I was excluding this overreaction here, the spike. We had a near vertical drop in the semis, so you have an over momentum fueled overshoot. It still captured that candlestick right there, the bottom of that one, the tail, and captured that one. So this was the breakdown, as you can see here, breakdown and back test over the last 2 days, and then impulsive move lower. And I think that's a valid trend line. But again, you can leave it there. You can put another one. It would just busy the chart up. Let's just now, at this point, to be safe, put a trend line here. And you're also sitting right on that horizontal support level there. You can see all the reactions from above and below. So to answer that question, do you modify your trading plan? You can. Now, just looking at that particular trade, not to get too much off topic, let me find that one. Here it is. The stop isn't too far below. I think that's only a couple percentage points. Again, it depends on how you're at. So you can either raise the stops here at this point, or stick with the original trading plan because you're not up here. I'll tell you that. If I were in this trade, and let's just say it had done this, and now we're at where we are today, where I'm watching for a very likely breakdown here in the semis. It could happen tomorrow. That could happen early next week. At that point, what I would do is raise my stop to just below this resistance level. It's resistance. If we had taken it out, it would become support because resistance once broken is support. So that at that point, I'd have a stop just below that level in case we went back down. And that way it would lock in profits, protect my gains. I'd be given a little bit back, but still allow for the possibility that this one maybe the semis move down and Brooks Automation continues to rise. Remember, not every single stock within a sector must fall. If the sector does, it certainly gives it some headwinds. Or The sector finds support. Maybe the sector even has another false breakdown below that trend line and then catches support at the next that horizontal support level that I showed you on the semis just below. So that's what I would do. At this point, again, it's your personal preference, but this one's not too far from the stop right now. Maybe raise it a little bit if you want, or just leave it there. So that's basically it. That's what I'm on watch for in the semiconductor sector. If we break this uptrend line, it's a little symmetrical triangle pattern there, and then this support level here. This line here, this would be my first target. It's about 121, this horizontal line, and that would be, I think, a 17% drop. And this level here, about 113, and from where we're at right now, that level is about 20. Yeah, about 23% or so down. So that's what I'm looking for in the semiconductor stock. So sell signal number one comes on a break of these trend lines, especially a daily close. Sell signal number two, and what I would consider the nail in the coffin would be if these lines go, and again on all three of those, XSD, SOXX, and SMH. And then, of course, you guys know I also track Taiwan Semi. I track them all really. Look at a group, kind of see how the leaders are behaving. And this is Taiwan Semi. You have to go back. This is a 2-year daily chart we're looking at. We have to go back even farther, all the way back to 2015 when this one bottomed. And it's a beautiful trend line with a lot of reactions. Again, I'm going to cut off that 2015 low here on this chart, but this has just been walking up that trend line, and we have had a divergent high here. So far, that has marked the top. We broke down for that little wedge, back tested, rolled over, hit that trend line, and again, we're visiting that trend line again. So, as of now, the trend is up. If you're a glass half full kind of guy or gal with the semis right now, then you want to step in and buy here. Buy at support. That's certainly support with a stop somewhat below, particularly on a daily close or two red candles below, whatever you want. Otherwise, if you're like I am expecting a nice correction in the semi soon, you want to look to position short on a breakdown. And if you're into individual names, I'd be glad to do an update on some of my favorites. I tried to do just a line there, not an arrow tool. There's some horizontal support just below on TSM, as there is with the individual semi ETFs. But all right, hopefully this helped. Again, the points I wanted to drive home are about having a trading plan, and then you have to make the decision whether you want to modify that trading plan. And I like to do so personally only if the charts pretty strongly convince me that the reasons that I got into the trade to begin with have changed. The outlook for the stock has changed. At that point, I might modify the trading plan. And also make sure, keep in mind, your risk to reward ratio. You've heard the old saying in Wall Street, cut your losers and let your winners run. And that holds very true whether you're swing trading or investing. All right, we'll wrap it up there. This has been Randy Finney with Right Side of the Chart, and hope you enjoyed it.